The Malaysian economy continued to register a strong performance in the third quarter, expanding by 6.2%. Sustained momentum in exports of goods and services has benefited the economy. On the supply side, all economic sectors continued to expand. The services sector benefited from continued growth in household spending, higher demand for data communication services, and robust trade-related activities. During the quarter, private consumption expanded by 7.2%, underpinned by improvement in labour market conditions. This is the fastest pace of growth since first quarter of 2015. Employment growth in the first 3 quarters of 2017 is more than double the growth in 2016, as firms increased hiring in line with strong economic expansion and greater business optimism. Private sector wage growth was sustained at 7.3%. Let's look at the household spending. It's strong, but consumers' confidence still below the optimism threshold. There are multiple factors contributing the state of consumer sentiment. First, rising cost of living. Wages have remained low, but higher costs have required higher spending. Second, lingering concern over job opportunities. Third, households have debt obligation. These challenges are even more acute to vulnerable households. Let me elaborate on some of these issues. Since 2014, the data shows that income has risen for M40 and T20 households, which account for 75% of private consumption. But rising cost pressures is particularly significant for B40 households, who had a small net rise in income amounting to only RM54 per month. If we dissect income further, wage levels and increases are relatively low for low to mid-skilled workers. Monthly wages of elementary workers rose by a growth of 10% compared to the previous year, but this amounted to only RM100, given the low income levels of around RM1,000. This increase could be completely eroded if this household faced any unanticipated income shocks. On private investment, it recorded a growth of 7.9%, benefiting from favorable external and domestic conditions. Continued optimism in business outlook and high capacity utilization led firms to spend on capacity expansion and replacement of machinery and equipment during the quarter. Let's look at the external sector. Trade performance continued to record robust growth, supported by favorable global demand. Malaysia's growth export recorded strong growth of 22.1% in third quarter of 2017. This was broad-based across Malaysia's key trading partners, particularly regional economies, the EU and the US. Growth of gross imports was also robust at 19.8%, driven by imports of intermediate and consumption goods. Malaysia's current trade strength is attributable to the established base of foreign direct investment, which enabled Malaysia to respond quickly to the increase in global demand. FDI into the country for 2017 is set to match record high levels in 2016, as Malaysia remains an attractive profit center for international investors. FDI remains diversified, both in terms of resource countries and recipient industries. FDI was a significant growth factor for Malaysia, a catalyst for higher exports, job creation and labour productivity during the 1980s and 1990s. However, there is growing evidence that the net benefit of FDI have been narrowing in recent period. reliance on foreign inputs, including imported materials, foreign workers, and foreign services, remain high and need to be addressed. With the fast-paced global environment, there is room to improve the existing investment incentive, such that Malaysia continue to attract quality investment that would enhance our future readiness with greater economic spillovers. We have a box article on this, and it's a very interesting article to read. Let's look at the headline inflation. It moderated to 3.8% in the third quarter of 2017. The lower inflation was due mainly to lower average domestic fuel prices relative to the second quarter. Headline inflation could remain elevated over the coming months amid rising global oil prices. Underlying inflation, which mainly reflects demand-driven factors, will be sustained by robust domestic demand. For 2018, headline inflation is projected to moderate on expectation of a small effect from global cost factors. The recent trend will depend on future oil prices, which remain highly uncertain. Let's look at the monetary policy. The OPR was maintained at 3% at the July and September meetings. At the most recent meeting in November, the MPC also left the OPR unchanged. At this level, the OPR remained accommodative and supportive of economic activity. The MPC, however, has the flexibility to realign this degree of accommodativeness given the strength in global and domestic macroeconomic conditions. Any potential adjustment would reflect a normalization of monetary accommodation rather than a tightening. It is important for a central bank to preserve ample space to buffer against any adverse shocks to the economy. The ringgit appreciated by 1.6% in the third quarter of 2017 against the US dollar and was again one of the best performers in the region after a strong appreciation in the second quarter of 2017. The ringgit strength in third quarter of 2017 was supported mainly by positive domestic factors, in particular better than expected second quarter GDP growth, sustained strong export growth. Going forward, however, we have to remain cautious as there may be tail risk events that would limit the ringgit appreciation. These include expected decision of monetary policy meetings of major central banks, geopolitical tension, and the economic outlook of major economies. The measures introduced by the FMC continue to yield positive results. Liquidity has improved, with daily volume registering significant increases. Volatility in the ringgit against the US dollar has also declined, providing a more conducive environment for trade and business activities, which reduce uncertainties. The negative impact of the NDF market of ringgit prices have also reduced, although volume in the NDF continue to be stubborn. We will continue to enforce our FEA rules on prohibition of ringgit trading offshore. The onshore forex market would now offer a more balanced foreign currency demand and supply as net conversion from trade has increased. Net external conversion from trade was higher at $3.7 billion in the third quarter, an improvement from $1 billion in the first quarter of this year. However, the net conversion rate is around 30%, still well below the required 75% threshold. Malaysia's credit default swap spread has also narrowed, reflecting improved investors' confidence. Let's look at the bond market. As at 30th September 2017, the non-resident holdings of Malaysian government bonds increased to 26.6% or 175.2 billion ringgit, an increase of 5.3 billion ringgit. The current level of non-resident holding is at a manageable level, which does not significantly exposed the bond market to the volatility of non-resident portfolio flows. We now have a more stable investor composition. The portfolio inflows were attributed to both domestic and external sectors. Malaysia's better than expected second quarter 2017 GDP growth sustained strong exports. Dovish Fed statements leading to weaker USD. Fed decision to lift the policy rate change. Increased participation in our local bond market was also driven by the upward trend in dynamic hedging volume since the additionality of flexibility given was announced in April 2017. The changes in non-resident holding for the quarter were mainly attributed to the increase in asset managers, central banks, and government holdings. Asset management holdings stood at 39.6%, and central bank government holdings stood at 32.9% of total holding, non-resident holding. On external debt, remain manageable. This observation is based on the nature and profile of our external debt. About 1/3 of external debt is denominated in ringgit and accounted by non-resident buying ringgit. Foreign currency dominated debt remained low at 42.9% of GDP. The bulk of this obligation are offshore borrowings, which remain low at 36.8% of GDP compared to 60% of GDP during the Asian financial crisis. The interbank borrowing and non-resident deposit are subjected to prudent liquidity management practices, which include, among others, limits on funding and currency mismatches. In general, the foreign currency denominated debt is largely hedged and backed by external assets. Intercompany loans are normally subjected to flexible and concessionary terms, such as no fixed repayment schedule or low interest rate. Trade credits are usually backed by export earnings. Let's move to the financial stability area. The bank has incorporated the Financial Condition Index analysis of financial condition to complement the use of other indicators. The Financial Condition Index, or better known as FCI, is a composite indicator that aggregates a range of financial variables from the banking system and financial market. The index summarizes the current state of domestic financial conditions. The FCI also reflects the enabling condition for future economic activity. This had helped to facilitate the assessment of macro-financial linkages between the financial system and the real economy. The latest assessment of FCI indicates improving financial conditions since 2016. The improvement has been driven mainly by the lower volatility in the foreign exchange and equity markets. Market volatility remained low amid improved domestic sentiment and low global volatility. Average volatility of 10-year MGS, yields and equity market declined, partly attributed to better than expected GDP growth in the second quarter. Domestic financial markets are expected to remain orderly, with investors' sentiment to be primarily affected by external development. These include uncertainty surrounding the pace and timing of the US Federal Reserve interest rate normalization, concern on the potential changes to economic policies under the current US administration, and increasing geopolitical tension. Domestic financial stability was preserved in the third quarter of 2017. The financial system remained resilient. Domestic financial market continued to function in an orderly manner. Confidence in the financial system was sustained. Banking system and insurance industry remained well capitalized to meet unexpected shocks without affecting any capacity to finance economic activities. At the end of September, excess capital buffers of financial institutions remains ample at 170.8 billion ringgit. Let's look at the trend of loans or financing. Growth in net financing moderated to 6.4% in in the third quarter of 2017. Net outstanding corporate bond growth was sustained and continued at double-digit growth. The lower loan growth was driven mainly by a slower growth in outstanding loans of non-SME businesses. This moderation partly reflected the higher repayment by a few large firms. Loan growth to SMEs, however, was stable at 7%, with higher loans disbursed during the quarter of 2017. The banking system continues to have sufficient liquidity to support the financing needs of the economy. At the end of third quarter, the liquidity coverage ratio stood at 136%, well above the minimum transitional requirement of 80%. The loan-to-fund ratio, which takes into account wider funding base of banks, remains stable at 83.1%. So if you notice, we do not use any more loan-to-deposit ratio data, as it's not a good indicator anymore. The expansion in household debt moderated further to 4.9%, accounting for 84.6% of GDP. Sustained debt servicing capacity with household financial assets remaining high at 2.1 times of debt. Delinquent and impaired loans ratios remain low at 1.4% and 1.6% respectively. Potential systemic risks are assessed to be limited given the following reasons. First, many new borrowers have prudent debt service ratio of below 40%. Second, the share of borrowing of those in the vulnerable segment continue to decline to 20.6% compared to a high of about 28% in 2020. Third, the bank stress test results affirm that banks have strong capital buffers to withstand potential shock and the severe assumption of loan defaults. Access to home financing remain intact, especially for first-time home buyers. Lending for this purpose grew at a sustained rate of 8.8% during the quarter. This has benefited first-time house buyers priced below 500,000 ringgit. The housing loan approval rate for this price category stood at 72.6% during the quarter. In the first 9 months of 2017, 121.6 billion ringgit housing loans were approved to close to 300,000 borrowers, 71% of which are first-time house buyers for house price below 500,000 ringgit. Total business borrowing in the third quarter was driven by fundraising in the corporate bonds and sukuk market. Despite an increase in the aggregate leverage of Malaysian non-financial corporation, aggregate debt servicing capacity and liquidity position remains sound. The median interest coverage ratio of listed firms was 8.3 times in the second quarter, which is significantly above the prudent threshold of 2 times. Moderation during the quarter was due to lower earnings attributed to several firm-specific factors. Delinquency and impairment remain at low levels of 0.4% and 2.6% respectively. Nevertheless, marginal increases were observed involving firms in real estate and oil and gas related sectors. In this quarter's publication, we have examined the common perception of SME financing in greater detail based on direct feedback from SMEs, banking sector data, and a review of bank practices. The findings point to a disconnect between perception and reality, indicating the need for continuing education and engagement programs to provide for SMEs with information on financing sources available and avenues that they can approach for assistance. Financial institutions remain the largest source of financing for SMEs, comprising 87% of total financing to SMEs. Total financing outstanding by financial institutions stood at 310.6 billion ringgit, covering all economic sectors. Of note, 1 in 5 financing to startup with less than 3 years of experience in business. This reflects a continued focus of banks on SMEs as a strategic growth segment. At the end of September 2017, financing of SMEs accounted for half of the total bank financing businesses. This share has remained on a continued uptrend since 2010. The supply and demand imbalances in the domestic property market is expected to increase going forward, posing risks to the wider economy. This subject matter is a contemporary issue that many have given comments. The residential market has an oversupply of higher-end housing and an undersupply of affordable homes. This is a great concern now as the level of unsold residential units is at a record high. In the commercial property segment, the vacancy rate in the Klang Valley office space has increased over the years and currently stand at 23%, higher than overall Malaysia, which is about 18%. With a large incoming supply of 38 million square feet in the coming years, one in 3 office space in the Klang Valley risks being empty by 2021. In the retail segment, an estimated 140 new shopping complexes are expected to enter the market, despite the increasing trend in e-commerce. We have a box article on this issue in this report for your reading. Let me conclude. Our assessment is that the Malaysian economy is on track to register a strong growth performance in 2017. Average growth for the first 3 quarters of 2017 is 5.9%. Looking ahead, the economy is poised to register strong growth that is close to the upper end of the official forecast range of 5.2% to 5.7%. Growth will continue to be driven mainly by sustained domestic demand, with additional impetus from continued strength in exports, particularly given the favorable global demand. Malaysia's diversified economic structure, supported by sound macroeconomic fundamentals, continue to enable us to withstand prevailing challenges in the global and domestic environment. We shall examine this window of opportunity by pursuing deeper structural reform, focusing on increasing productivity and strengthening physical and digital infrastructure. Over the years, as you know, Bank Negara Malaysia has introduced various policy framework and regulatory enforcement to strengthen monetary and financial sector stability in the country. We wish to provide a brief insight into this and update on key policy initiatives by the bank to elevate the corporate governance standards of financial institutions in Malaysia. There's a feature article in this quarter's bulletin that provides a detailed account of this initiative. The evolution of regulatory framework has enabled the boards of financial institutions to more effectively discharge their fiduciary responsibility. Strengthened board oversight has been observed following the increased board independence, clearer separation between the function of board and management, improved competency, composition, and commitment of board members. While financial performance and business strategy continue to dominate board's discussion, other matters such as technology risk, compliance, and risk management are receiving greater prominence. We expect boards to keep pace with changes in the financial landscape and continue to steer the financial institution with integrity, professionalism, and applicable ethical standards. I have come to an end of this presentation.